When it comes to investing, a majority of people make it incredibly complex when it doesn't have to be. So in today's live stream, if you have some questions, definitely drop them in the chat. But I want to break down why investing matters more than ever and what we're actually seeing, what you can do about it. So this is very important when it comes to the younger generation. I hear this a lot when I have people coming into my financial institution, when we have chats online and YouTube. I'm talking about they understand the thought or the process behind investing, but they don't understand the reason. They don't have a direction. They don't know what to invest in. And a lot of people, even how to get money from a financial institution, a bank, or a credit union into an investment account easy, and then investing and really get it starting. So let's kick this off, guys, with the first one and really the basics, why investing matters more than ever. Big part of this is inflation. When you look at inflation, when you look at the cost of living, both of them are going up. And over the last couple of years, they have went up astronomically. When you start looking at savings, let's say you're putting your money in a traditional financial institution, your Chases, your Bank of America, Wells Fargo, Fifth Third, whoever it may be, you are losing money. I have to say this, and I really have to stress this point. If you're keeping your money in a traditional savings account, most of them are paying a 0.2, a 0.01, a 0.5. You are losing money. With inflation running about 2.8, 2.9%, and the cost of living increase just on, CPI, consumer price index, that is increasing. Savings will not and cannot alone keep up with the increased cost that we see. Now, of course, when it comes to investing, the earlier you start, the more time your money has to grow. This is one of the biggest things where a lot of people miss is they think that when they're 16, 17, 18, when they first get an investing account and when they start investing, even though they have a very small amount of money, it doesn't make a difference. Most people start investing and really focusing on the investment when they get a lot closer to retirement. We're talking 35, 45, even 50 plus when you start planning for retirement. And at that point, you've already lost your 10, 20, 30 years that you could see an incredible amount of compound growth. Now, for a lot of people, it doesn't even have to be a ton of money that you're putting into the investment unless you're investing or starting investing really, really late. We're talking about $50, $100, maybe $200 on a regular basis from the age 18 all the way to retirement at 62, 65. You can have well over $1 million. I know Dave Ramsey, very famous for saying this, when you start investing at $100. Now, when you're starting at 18, $100, putting it in there doesn't seem like a lot. It's not going to grow very much. You're not going to see a huge impact. It is the compounding impact over an extended amount of time that really builds wealth. But of course, the $100 that we're starting with is not just going to be the investment for the rest of your life. You'll start in a career, you'll be earning more income. You'll start getting, let's say, a 401k match from an employer, where if you're putting in $100 or $200 and they're matching that, your contributions will go up exponentially as your income goes up exponentially throughout life. But again, the earlier that you start, the better, and really the better you're going to do forever. Now, when it comes to investing, like we said, it is not just for the wealthy. It is about anyone who wants financial freedom. We talk right back here about the debt-free journey, financial freedom, and honestly, the only way you can get it is having and saving money, investing money. There's a lot of caveats where, if you got real estate, you can generate money that way. A majority of people don't do it that way. A majority of millionaires, even looking at all of the studies and all of the information that you kind of follow, most of it comes from 401ks. Most of it comes through regular contributions over that 20, 30, 40-year period, which is incredible. Now, of course, your future lifestyle, the life you want to lead during retirement, depends on what you want to invest today. If you're going to live a life where you might get to retirement, you don't have any or really almost no expenses at all, you can live an absolute incredible life. But if you're at the point where you want to travel, you want to golf, there are going to be expenses that are going to be incurred during retirement. That is the point. Your future lifestyle really does depend on what you're doing today and the amount that you invest today, because investment builds independence, not just income. Now, I know there's a lot of places where if you're making, let's say, $50,000 a year, you build up that portfolio to about $625K, you can replace the $50,000 income with a regular gross, and really replacing your income when you get to retirement is the goal that I have personally. And I know a lot of you have shared the exact same thing. Now, when we get into number two, It is the mindset shift. This is what I honestly believe for a majority of people, from saving to building wealth. They are really two different things. When you have money in a savings account, it is about the protection. When you think of a financial institution, it is FDIC insured. Your money is going to stay there. It's going to be safe, but it is not going to grow. When you start investing it, that is where we start seeing the multiples. Even thinking of my personal investment portfolio, over the last 4 years, it's grown over 100%, which is kind of crazy. But thinking through, the market pullback of 2022, I invested, I dollar cost average through that entire time. Then we look at 23, 24, and now going into 25, double-digit returns year over year over year. It is not about luck. It is about consistently investing in the market, not about timing. If the market's going up, I am investing. If the market's going down, I am investing. When we start looking at the investing time frame, we are talking long-term focus. We are looking at decades, not days. And I know a lot of people, I was even reading an article with Warren Buffett that was talking about when he buys into a company or when he starts putting money into an investment account, that is an investment account and he is putting money in there forever. There is no plan to sell. Now, he might change up some of the investments, take a little bit less of Apple, maybe add on a little bit more Coca-Cola or a bunch of different companies, but he has no plan to actually sell out of the portfolio and keep that and really just kind of cash out of the market itself. Now, of course, it makes it interesting. And a way to do this is paying your future self first. Invest before you spend. This is where we talk about automation, and I've really stressed it a lot. When it comes to 401k plans, when it comes to IRAs, when it comes to HSAs, when it comes to even traditional brokerage accounts, make sure you're putting a couple percent away for that future self, 3%, 5%, 10%. Ultimately, the goal of where we want to get this when it comes to shifting your mindset is 15%. And of course, you can make this very easy if you do it very early. When you start investing, let's say you're putting away 4%, then you raise it to 6, then 8, then 10, then 12, then 15. A gradual increase like that, you're not going to feel quite the impact. If you start out of the gate and do 15%, and that's exactly what I did, started out with 15%. Then the first year that I was in a financial institution, I got about a 4.5% raise. I kept all of that raise. I was already at 15%, staying at 15%. And now for the last 20 years, I have been investing at 15% in my 401k. That doesn't include, in that 15% does not include the company match or anything benefits, any bonuses, anything like that. It is a straight 15% because money is a tool and it is used to create opportunities, not just security and not just well-being. Now, when it comes to investing, and of course the basics, understanding the simple basics. What are stocks? That is ownership of a company. What exactly are ETFs? Now, if you've watched any of my financial videos, any of my investing videos, I only invest in ETFs. I do not like individual stocks. I would rather own ETFs. ETFs are a big basket of stocks that you can buy, and it's just like having one share of a company, but it has a ton of companies. Now, for me, index funds, I absolutely love as well. But when it comes to those ETFs, I invest in a majority of my portfolio is in the Vanguard S&P 500. There's a ton of different S&P 500 funds, but overall, that is the foundation to a portfolio. And either doing something like the VOO with the S&P 500 or doing something like the VTI, which is going to be the total stock market in its entirety, choosing one of those. And again, there are a lot of different variations. People asking about the SPY or the IVV. There's a lot of different acronyms, a lot of different ETFs out there, but overall, they track the exact same market. So regardless of what flavor you're getting, just knowing that you have exposure to the entire market in itself, really it is super simple, super easy. When I have investors that are talking about, I'm just starting out investment, where should I put my money? Start by getting something like an S&P 500 fund. It is really, again, the foundation. It is a game changer out of there. You can do some satellites and a bunch of different ETFs, but we'll talk about that later. Now, of course, when it comes to diversification, it is the reduction of risk. You are not betting everything on one company. For instance, if you start investing and you're investing in, let's say, NVIDIA, very good company and probably one of the only ones that I would recommend if you want to buy an individual stock. That is a company that I feel like has a lot of runway. But overall, if there's negative news, if there's tariffs, if something happens fundamentally with one single company, there can be a pretty massive drawback in one company, where again, when you think of something like the S&P 500, if there's a drawback in a couple of the tech companies, you still have 11 other sectors that can cover you and that you're not going to see maybe quite as much as a pullback. So buying and holding those broad market funds really provides stability and growth in a portfolio. And even when we think of long term, so over, since the S&P 500 and really the VOO and the SPY, which was the first ETF we've seen, they average about 10%. When you think of a savings account, even a high yield savings account at 3 to 4%, when you think of a traditional savings account as at a 0.05 or a 0.01, getting a 10% return over an extended amount of time will grow wealth, and it will grow wealth incredibly well. So how exactly do we start investing in here? Now, to start investing, you don't need thousands, tens of thousands, hundreds of thousands of dollars. Most of them are 10, 25, $100. Even when you look down below, and I will put the links down there, I do use M1 Finance. I know it is a fintech. A lot of people do like it. I also do use Robinhood. So if you want to go for the all app, Robinhood has a lot more of kind of the gamified investing. But when you start investing, $10, $25, guys, it's really about setting your future with these very easy beginner, really user-friendly applications, buying fractional shares, where if, a share is trading at $600, you can put $25 in there. It will buy a fractional share, meaning you own a piece of a company. It makes a big difference. And honestly, when you're getting to the point of owning assets, that is, in my opinion, for me personally, that is where my life changed, is when I started focusing more, not on the physical things or the wants that I have or the things that I buy. And I know Gary Vee, I watch him quite a bit, but looking at all the stuff that we purchase versus having something like assets, having something that is actually going to build, that is going to compound, that is going to grow, whether it's investing in yourself, whether it's investing in the market, it really makes a big difference. Now, of course, we talked about contributions and making it automatic. Consistency in contributions will build momentum. And here, again, if you're starting off, if you're 18 years old, you start a job, you're investing in the S&P 500, you're putting, let's say, $25 in there every paycheck, it's going to add up. If you're 18 or even 20, going all the way to 65, making those consistent contributions, it is going to build momentum. It is going to build really the compounding effect that you want to see in portfolios, focusing more on the habits than the hype. Now, a lot of people chase the hype. They chase the meme stocks. They chase the cryptocurrency, the get rich quick. And it's incredible how many people that I see get completely burned on all of this because they want to make $1 million by next week. And unfortunately, for a majority of us, including myself, that is not the way investing works. You could take a long shot. You could bet in cryptocurrency, even buying Bitcoin 15 years ago. But overall, it still took 15 years to grow. You might be a millionaire, you might be a billionaire with cryptocurrency, but there's some point where you have to enter into it and you have to hold it for an incredible amount of time, investing on a regular basis, regardless of the noise. And they like to really sell the news, really the fear factor. And I've really gotten to the point of being able to tune out a lot of the market noise and the things that you see. Because of course, if you want to see all of the negative, trust me, social media, algorithms, everything else we have out there will feed you all of the negative BS that people see. The market's going to crash. It's going to do a downturn. They even said 2026, since 23 and 24 were great years, 25 was going to be way in the red. It was going to be way in the negative. We'd see it absolutely crash when President Trump took office. Then the tariffs, again, it was going to crash. Everything was going to go down. Guys, the market goes up and down. It's happened through all of history. If you do your research, when we start looking in a 10-year period, we have about 8 positive years to 2 negative years every 10 years. It's just, again, thinking of history, thinking of what we've seen in the stock market, the dot-com bubble, thinking of the housing market crash, 2017 when there was a pullback, COVID. There's always been, within about a 10-year period, 1 or 2 years that are kind of flat, one of those 2 years that are kind of negative. And again, that's focusing on really that S&P 500. So then we get into the magic. That is the power of compounding. This is where wealth is created. This is it. If you understand this, so compound interest is getting growth on top of growth. that is where your money starts snowballing. When you're starting to do contributions, and then of course your contributions start growing at that 10% every year, it gets faster and faster and faster as the snowball gets bigger and bigger and bigger, which is kind of crazy. The earlier you start, the less you have to invest later in life. And again, if you're starting at 18 to 20, putting away 5, 10, 15% of your income, it is kind of crazy. Now, missing early years will cost more and are more detrimental than any market dip that we've seen in history, which is kind of crazy. Not only the compounding growth of what you're investing in, like the S&P 500, but when you also look at the dividends, that is free compounding fuel that goes on top of what you already have. When you're getting dividends and when, again, you start rolling that snowball, that's the reason why time in the market, not timing the market, is the secret to wealth building. When we start looking at a majority of millionaires within the United States, it has been an extended amount of time in the market, and it is that easy. Making consistent, constant contributions into the market, it will grow, and it will grow incredibly well. Now, if you are newer to investors or investing, there are a couple things, and we want to make sure that you avoid them. So don't chase, and not chasing any of the hot stocks, the trends, coming up with a plan. Now, a lot of people do this and they really kind of miss out is when they start investing, they don't have a portfolio set and they don't have a plan on how the investment strategy is going to go. They don't know exactly what it's going to look like. This is where, again, before you get into investing, before you go in blindly, coming up with a plan, coming up with a portfolio, doing a lot of research and knowing exactly what it's going to look like. For instance, if you go into something like M1 Finance, I can build a portfolio with the VOO. We can put, a couple percent in some high tech or a little bit more risky. We can put something in a little bit more safe, like an income generation. You could possibly even looking at bonds or international. You can build and really research an entire portfolio with 2 or 3 ETFs that are going to be incredibly easy. This keeps you from avoiding and investing emotionally. Fear and greed are the 2 biggest things that ruin portfolios. When we look at people, and again, kind of the traditional methodology is when the market is green, when the market's going up, people will invest, and people will invest more than they ever do, which on the opposite side, when the market's declining, when we're seeing a pullback, you and most people will sell out of the market in the entirety, or they'll lock in those losses. What we mean by this, and honestly, this is probably one of the most common mistakes that I see, is if you buy 100 shares of an ETF or 100 shares of a company, all of a sudden the company goes up and the value goes up $10,000. You still own 100 shares. If the value of the company drops down $2,000, you still own 100 shares. The only time that you realize, or the only time that you actually have a profit or you have an actually loss within the market is when you choose to not play the game anymore and when you choose to sell those 100 shares you have. You have to realize that, again, like we said earlier, portfolios are going to fluctuate. We're going to see ups, we're going to see downs, we're going to see market drawbacks. It's really the dollar cost averaging aspect that does incredibly successful and will do incredible. Now, when it comes to investing, not leaving the market, and do not afford, and you cannot afford to leave the market, we're talking investing at a 5+ year time frame. If you have a much shorter runway, if you don't have that 5-year time frame, if you're going to use the money for something, if it's going to be earmarked for something, you want to make sure what investment account you're investing in, or not investing in an investment account at all. Because when you use some of your retirement tools, we're talking 401k plans, we're talking IRAs, you do not have access to the money. This is where possibly putting money into like a traditional brokerage account does make sense, for the simple fact you do have access to the money without having to take massive penalties or massive hits on your retirement account if you're taking out money early. And of course, watch for hidden fees, watch for management costs, and also look for expenses. When we start looking at expenses of some of the managed ETFs that we see, or some of the managed mutual funds, they can get very expensive, and you got to make sure the return really justifies what you're paying in the cost, because again, it can be very expensive, and there's never going to be a better return than eliminating debt. When it comes to debt, it is the absolute number one fastest thing that is going to crush your wealth. When you think of an investment portfolio, a good year is 10% in the S&P 500 when we see regular growth. But on the flip side, When you look at credit cards at 20, 25, 30%, you are losing money by investing at 10% versus paying off that high interest debt at 20 plus percent. You have to make sure you run your numbers. And of course, make sure you have your emergency fund. Emergency fund, we talk about this a lot, making sure this is going to be protection. Growth is going to come second. Protection is going to come first. Because if anything happens to, let's say you lose your job, something happens, there's an accident, you have a big unexpected expense, you're going to get completely burned because you don't have that emergency fund. And of course, the final one that we're getting into, number 7, building your long-term strategy. Like I said earlier, when it comes to building your strategy and your investment strategy, setting clear goals. What are you investing for? And you could even have more than one portfolio. For instance, let's say you have a portfolio that is for retirement. We are talking 401k plan. We are talking this is going to be a retirement. Once you hit 62, 65, 68, whenever you retire, this is going to be the account during retirement. This is what you're going to utilize. Now, of course, if you want to retire early, you could even set something out with a little bit of earlier wealth, possibly a brokerage account, because you're going to need that money before that 59 and a half if you're looking at early retirement, or if you're looking at financial freedom, debt-free journey, whatever it may be, making sure, again, that you have a very clear goal of how you're going to get there. And for a clear goal, and honestly, making it the more specific that you can make a goal, the better it's going to perform. Setting it specifically, setting it really intentionally, setting time limitations or time frames around it, make a really big difference when it comes to your goal, and being able to actually set and exceed or meet that goal does make a big difference. Now, also diversification. When we talk about long-term and really long-term investing, diversification, we're talking stocks, we're talking bonds, ETFs, international. There are a lot of different ways to build portfolios. So again, make sure you do your own research, automate your investments, automatically putting away that 15%. It removes the emotion, it removes the fear, it removes everything from the process. And even when it comes to these 401k plans, for a majority of people, they will set a certain amount. And again, thinking of the company match, let's say it's 4%, and they will not look at that 401k plan for weeks, months, years. It is a whole entire different mentality when you're putting money into that retirement account in a 401k. Because I see on the flip side, people get like an individual brokerage account or a taxable account, and they will look at that thing 2, 3, 4, 5 times a day. Markets going up, markets going down. What do I need to do? What adjustments? What does your goal look like? What does your plan look like? Are we still on target for your plan? Do we know exactly what you're looking at? And of course, when it comes to rebalancing, now rebalancing is one that I get a lot of questions on. Now, when it comes to rebalancing, some people say to do it once a year. Some people say to never do it. And I know Vanguard CEO actually had a pretty good statement on this and a pretty good reason, I guess, for the logic. So when he was talking about rebalancing a portfolio, he said there is not a reason to rebalance the portfolio, just for the simple fact that you are selling off and liquidating and selling your high-performing assets to replace it and buy other assets that are underperforming. Now, I can see if portfolios are crazy and significantly kind of out of adjustment, but it does really have something to be said when you have something, let's say like NVIDIA, that's up, 1,800% in the last year, and you liquidate a big chunk of that portfolio holding NVIDIA, just for the simple fact you want to buy something else like the SCHD that is very, very strongly underperforming. It can be kind of disappointing because, again, you're selling off a stock that is performing incredibly well to purchase a stock that's underperforming just to keep that balanced portfolio, which is kind of crazy. And of course, when it comes to a long-term investing strategy, staying patient, really building up that wealth is going to take time. It doesn't happen all at once. It happens over an extended amount of time to really build that portfolio and grow an incredible amount of wealth. So, all right, guys, so that is going to do it for the live stream. Definitely love doing these. I want to get doing these probably twice a week. That way I can answer your questions about investing, about finance, debt repayment, anything at all. Guys, definitely drop them down in the chat. I will answer the questions as soon as I can get to them. But guys, if you found it helpful at all to go through here and really break down the investing made simple, there is a very general guideline that you can go by when it comes to investing. Definitely like the video. Go ahead and share it, subscribe to the channel. The channel has been growing exceptionally well. So welcome to all of the new subscribers we have. And again, thank you guys for joining me for live stream. We're going to start trying to do this at least twice a week. I'm thinking like a Tuesday, Thursday, to be able to hop on here and answer all of the questions as the channel continues to grow. So again, guys, thank you guys for joining for the live stream, and I'll catch you in the next video.